I must say first, this is kind of intimidating, because this was just one of the most perfect introductions to the issue at hand I've ever heard. Yeah? So Larissa, that was fantastic, and I'm close to saying nothing further, Your Honor. Yeah? But there is one tiny thing, one particularity where I do not necessarily agree. Actually, something where I have to fundamentally object. What I'm about to criticize a little is reflected here in the title that I have chosen. Yeah? Investing is not female, it is not male either. The financial market is the great arbiter. And I think there is something important to learn here. What do I mean with that? Investing is not female. Well, I think everyone who claims that female investment leads to more yield, leads to an additional return, is actually question a very fundamental knowing about modern markets. Yeah? If there ever was, or if there was such a thing like an additional yield, an additional return through female investment, then this would actually contradict everything that we know about efficient markets. Because the thing about efficient markets is that they are transparent, and transparent markets reveal that factor, that particular factor, with the result that they steer all the liquidity, all the money into that factor, and that in the end, the factor is leveled out. So whenever, and that is my advice to the audience, whenever someone approaches you claiming that he or she has identified a certain factor, be it the female or male investment, be it the dividend issue, be it the size of the company, whenever someone claims that he has identified that factor, that I would really, really question that and be very cautious, because modern markets level that out. Always provided, of course, that you are a private investor. The whole game is entirely different when it comes to institutional investments. There it might play a role, if not the dominating role. And that may lead to a pre-assumption that we all have to make before I come to my advice today. I need to align with you about the nature of the investors I have to deal with here today. So I consider you, the audience, to be in their late 20s. I consider you to be, and I can't emphasize this enough, to be a retail investor, yeah? not an institutional one, with, let's say, 100 up to 300 euros available for saving or investment is actually the better term here. Yeah, private investor, because it pretty much defines the time and effort you can spend on the subject at hand. And yeah, if you consider yourself to be of that nature, then I think there are just 3 basic questions that you are looking for, where you are looking for an answer. You ask the question, what should I buy? When should I buy it? And how should I buy it? Oh, we have a certain delay here. And the answer to that is very simple. And please keep that in mind, recollect it every time when you approach your investments. The answer to what you should buy is very simple. It's basically everything. When you should buy it on a regular basis. And how should you invest? You should invest as efficient as you can. So I will, of course, further elaborate on that. Yeah, that is the mission statement, the guiding principle, the motto that you should keep always in mind. And how does this now materializes? How can you apply this in practical terms? Yeah? You should go for a global mix, of course, and I represent an exchange, a global mix of equity here. So what hides behind that term is you should relieve yourself from this burden of stock picking. Warren Buffett is maybe I also question that, capable of doing so. You won't. And I would even abstain from, selecting individual markets. What I would do is I would approach a portfolio that comprises of basically all the big international indices. So what I'm talking about is the old issue of diversification. When should you enter the market? Well, you should enter the market in a long-term manner with a savings plan. Yeah. So you just take your whatever is left on a monthly basis or on a quarterly basis or even on an annual basis and put it into the same instrument in a very regular way. And what the key message is here is that you should fundamentally abstain from the and I know it's very tempting. Yeah? You should fundamentally abstain from timing the market. You should not try this. There is a saying, and that pretty much hits it: time in the market beats timing the market. Yeah, Warren Buffett claims to have that talent of timing the market. Yeah, but no. Warren Buffett actually also says that time in the market beats timing the market, but there's plenty of noise around that claims that timing the market makes sense. Yeah? I can also say from all the personal experience that I have gathered over the last 2 decades, just stay in the market, because that's basically the one and only general experience that is really certain in modern financial markets. Yeah? And that is global constant growth and stock prices that always reflect this in the long term. Last but not least, the how to do it. Yeah? You should do it in a transparent, inexpensive, and fungible way. And here it gets a little tricky, of course. Yeah? Transparent, that has been already covered by Larissa. You should only buy what you understand or what someone can explain to you. Yeah? And you should do this, you should generally approach the market in the most possible inexpensive way. And what do I mean with that? Well, the total cost of ownership on an annual basis, I would say, should not exceed a level of 50 basis points, maybe. Yeah? So 0.5%. Yeah? I would even consider the benchmark lower nowadays. The ETF total cost of ownership starts at 15 basis points. There are some that offer it for free even, but you should really be cautious about that issue of the costs. Yeah? I should have calculated it through, but we have no time for this today. But let me make a guess. If you take your 300 euros on a monthly basis and invest that over a period of, let's say, 20, 30 years, so approaching a end sum of something in between of 200 and 300,000 euros, a cost of 100 basis points on an annual basis will take away at least 50, 60,000 from that. Yeah? So this really sums up when you apply the requested long-term approach. What can you expect out of such a strategy? Well, it is a annual return somewhere in between 5 and 10%, depending on the instrument you choose. Of course, that's only a range that I can offer here. And what you will be most possible also be confronted with is a certain downturn. These incidents occur very rarely, yeah, but it happens, as we've seen in the course of the collapse of the dot-com bubble, as we've recently seen with all the volatility in the markets in the course of the Corona crisis. But markets have also shown this fundamental eternal truth of long-term growth of the world economy, yeah, and stock and share prices that reflect that naturally. So this is basically it. this is my general advice. Yeah, a general guideline that you should always bear in mind when you approach the market and when you go into discussions with the financial industry. Yeah, approach the market with a global mix of shares. Do that in a long-term manner through a savings plan, and yeah, please watch the costs. One can't emphasize this enough. And now you might ask me, okay, Mr. Boschan, tell me specifically what bank and broker to choose, and in what instrument should I invest in? Well, I represent an infrastructure provider. We are strongly committed to the neutrality and to the equal treatment of all the participants and banks. But I've seen today's lineup, and there are plenty of distinguished lecturers that will most probably approach you even with specific ISINs, so security identification numbers. Yeah, I wish you fruitful talks and very informative evening. Thank you so much.